Let's see. Here we go. Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. Today, I'm joined with Doug. Hey, Doug.
Hey, Kirk. Happy Friday to you. And hopefully, this isn't the last time that we are able to do this because it sounds like now AI is going to create the next wave of viruses to kill us all. So. So we thought that Terminator meant that we would go to war with the bots. It turns out we're never going to get to war. We'll all just have to, have 6 feet of separation and flatten the curve indefinitely.
Let me guess. That was from Anthropic?
I did not see that it was from Anthropic in general, but it was an announcement over the week that they have now. The AI was able to replicate 12 different viruses or something like that came in the news. It's like, oh, great. So now it's doing biological creation, which is wonderful. Good for us. Again, it was scientists said this, so who knows these days?
Follow the science, Doug. Follow the science.
Hey, one of the stores near me still has the 6 feet stickers on the floor. So I'm ready.
Yeah. Well, that's funny. They haven't bothered to update it in 6 years.
They haven't scraped the vinyl off the new vinyl.
Oh my God, that was a crazy era.
Okay, I not to be too cynical for those that might be listening here that actually believe in the separation. Yes, exactly. But the most hilarious thing about the whole thing was and how just the sign of just how rushed, chaotic, and stupid. Besides digging up parks, which I think I went off on last week.
They did what? They dug up parks?
Yeah. You remember that? Do you remember this?
No, I don't remember them digging up parks.
So because of separation, and what they did is they wanted to prevent any kind of commingling of people. So I think it was in California, they were literally taking bulldozers and ripping up skate parks and places like that, which of course we now found later hurt 3 things. First of all, mental health. Number 2, vitamin D because they were outside, and number 3, actually being mobile and exercise, which lowered the comorbidity. So just to keep people from collaborating together, they were bulldozing parks. So yes.
Well, let's be honest, California's cuckoo anyway. So
yeah,
I know some of our listeners and some of our panelists are from California, but they're still cuckoo.
Hey, I live in Minnesota, which, hey, it's the whole meme. Another day goes, 0 days since the last time we were an embarrassment. Yeah. But so I get it because, we my government wants to be California in a lot of different ways. But the not to get too far off track, these vinyl stickers that would be put into stores with 6 feet of separation, right? And it would be 6 feet apart vertically, but they would be 3 feet apart horizontally. So you couldn't be 6 feet to the closer to the person in front of you, but you were only less than 3 feet to the person next to you.
I know. It's people are going to go back and look at history and be like, wow, why were they so stupid? But the reality is we're human beings and we're easy to manipulate. And that's all that was a big manipulation. The news does it all the time, fake news with fear. The government did it and we all fell for it. And, what do we get from it? We get 114 times of, I plead the fifth from Fauci, even though he's got,
I plead the fifth. 1, 2, 3,
even though he's got exemption from getting prosecuted, he still did that, which actually be interesting. I said this last week. There's, if you're getting brought in front of Congress, that you're getting off scot-free. You're not gonna go to jail because Congress is your get out of jail free card. If you sit in front of them and whatever you do, even if you plead the fifth, you're not going to jail. So if they send Fauci to jail, I would be surprised, but it would certainly be a welcome reprieve because everyone else does not. Which I think is a shame. It's just a show. It's a show for the plebs, show for the serfs. Keep them entertained. Keep them bitching about Fauci and whatever. I don't know. Anyway,
it's the meme. Are you all entertained? Right, from Gladiator.
Yeah. Well, I will say Dave Chappelle is getting a lot of. I don't think he gets any sort of royalties, but God, he's got to be getting royalties for all the memes going around about his "I plead the fifth" skit.
Yeah.
He's got the best sketch comedy. He's the GOAT. I'll tell you, the sketch comedy he had that keeps coming back. It's awesome.
Yeah. We're a family show, so we'll stay away from the non-PC of the Great Chappelle Show. But I honestly go back. You know, you said something last week about when he kind of left at his peak of fame.
Yeah.
One of the big reasons he cited that he did is became overwhelmed after Richard Pryor basically went to him and told him, and this was right before Richard Pryor passed away. He said, "I hand you the crown." And, you know, Richard Pryor, especially in black comedy, is literally the emperor, right? He is the epitome of, just pushing society and, and to be told that. And it was just an absolute just rush of, what an honor, but at the same time, what pressure to be, your idol in the comedic world to hand this crown to you. And I think that was a big portion of like, wow, this is becoming way bigger than I had ever imagined.
Yeah. Yeah. Well, kudos to him. I'm a fan of comedy. Dave Chappelle is the GOAT in my mind, and his sketch comedy. It's funny. I was talking to somebody last week about unrelated, but we were talking about Mad TV and In Living Color. Because, every once in a while I get nostalgic about the old days, and I tried to look it up. Oh, where can we go see this? I didn't even remember Mad TV, but In Living Color was awesome.
It was incredible. Jim Carrey.
Yeah. Yep. Jim Carrey, Tommy Davidson, you got the Wayans brothers. Yep. It was, it was awesome. And I went back and started looking at some of the sketches, because it's all sketch comedy for both of those. I didn't really remember Mad TV, but once I did, I was like, okay, yeah, it was okay. But nothing beats the Chappelle Show. Only 2 seasons of it, but it was remarkable at how funny it still is today. So, just I won't get into it. But it's awesome. It's maybe it's not all fully family, but it's pretty good. It's all pretty good. Anyway, let's talk about this. Let's talk about this week. I mean, we still got another 4 more. Yeah, 4 more weeks, because we got a late Labor Day this year. 4 more weeks of summer for Labor Day. I know a lot of kids go back to school in August, which I think is a travesty. We should be going to school in August.
I got to interrupt this. They go back to school in August. My daughter goes back in 2 weeks. She already got an assignment from her AP class for like 4 or 5 assessments that need to be due the day they come back to school. That to me should be illegal.
No, I mean, my kids, I don't know how it is in public school. My kids go to private school, and I can tell you that they always have summer assignments. They always have since like
my daughter's
since like middle school, I think, or 6th grade or 5th grade. They've had them. I mean, I didn't know that wasn't. Anyway.
Yeah. Anyway, come on.
It is what it is. I think it's fine. You got to read 1 book and have an assessment first day back. I mean, I did this in high school. I just read the book the day before or week before. And
this is for AP Science, and I assure you that what she's being asked to do is like way beyond just reading.
It's AP, Doug.
I know. Big and high achievers.
Anyway, if you want to be that kind of kid, then that's what you got to sign up for. I mean, hell, the burden you're putting them under to go to the Ivy League schools and all the stuff they're trying to get into, great. That's why you're there. Otherwise, you can get in the remedial class, the remedial science class, But whatever, it is what it is. Anyway, so we're in the heart of summer. I'm taking off in a few weeks for vacation, which would be nice to be down the beach. But I have to say, the summer's been pretty awesome. So let's kind of dive right in, because this week has been interesting. We talked about last week about how the markets are in a range, and they were up until 4 days ago. 4 days ago, I think it was Tuesday, where Monday the markets shot up, and then Tuesday they broke out of the range quite handily, I might add. Sharply broke above the range on the S&P was right around 7,600, 76 and change, and then Tuesday it broke out to 77. So pretty big move in a day, and subsequent days have just been kind of marking time. But that's a pretty handy breakout. Now, when you see stuff like that, I'm gonna share a chart here just for everybody so you can kind of follow along. But when you see a breakout like this, here's what you want to take away from it. All right. You want to take away that, and actually not all indexes have broken out. So I'm going to share the NASDAQ too, just so you kind of keep pace here. All right. So here are the charts. Here is the S&P 500. All right. So this chart, I don't know why. There we go. Okay. So this, what? Okay, here it is. So this chart right here, this is the S&P 500. What the?
Least, hey folks, least this time it's not on me. No.
Yeah,
usually I'm the technology problem.
Yeah, this is, I'm not happy. Whatever. Okay. Well, anyway, this is a software. So, all right. So this is the S&P 500 chart for the past year, and what you see here is you see that it's kind of marked time. It's gone down for the in March for the war, and then it bounced right back up, and it's been in a range pretty much since May. And so this range right here is what we've been talking about. It hasn't been going anywhere. And then this week it broke out of the range. It broke out much higher. Apparently, so right here was the bottom of the range. This is where the down day was, where Leopold got taken to the cleaners by Citadel. We talked about that last week. And then subsequently it quote unquote marked the bottom, and then it just shot up. Apparently the war stopped for a day, which I always scratch my head and say, why is what Trump says about the war matter at all for the markets? But apparently it did, and the markets are going higher. And so this range, this top end of the range, when we broke out of that, that's bullish, right? That's bullish. That means the market's going higher. Now, you might say, well, hey, why don't we just go all in because it's going to go higher? Well, here's how the markets work. Now, if you're in a range, you can do one of two things. You could do nothing, or you can trade the range. By trading the range means you sell at the peak and then you buy at the dip and you go back and forth, back and forth. I tend not to do that. I think you can, some people do it. I tend not to because you don't know what's going to break out. The probability is such that it's not going to be in the range forever, but it was for a while. And so the thing you can do is either wait and do nothing, or wait till it breaks out. And then when it breaks out, then now this is bullish and the market should continue higher. However, here's what you have to watch for. So typically when you have a breakout, what will happen is the market will retest this range, the top of the range. So the top of the range is what we call resistance when you're in the range, and once you break it out, is now support. So these range tops, what they do is they mark buyers and sellers where they are. So the top of the range is where the sellers are. Bottom of the range is where the buyers are. That's why it's a range. So when it hits the bottom of the range, people buy and then they push it back up. When it hits the top of the range, they sell and push it back down. So typically within the range, you don't want to do anything at the top. You want to wait till it breaks out. Well, it did break out. It broke out pretty strongly, which is a good sign. Now, what you want to see with that, though, is what's typically happens when it breaks through the range. Probability says that it retests this support line. It used to be resistance, now it's support. So what typically happens in the range is people will sell at the top, but once it breaks out, people will typically buy at this line. And we're talking psychology here, but psychologically, the way traders look at it is they look at it as a psychologically important line. You don't always know why. Sometimes it's just random. Sometimes it's because there's a lot of volume. Sometimes it's just like a number, like 7,000 or 8,000, like a number like that. People will mark that as significant, even though there's nothing significant about it, but the market will mark it as significant. So you want to keep an eye on these lines. Is there a visual representation of a support or resistance line, or is it just a number? We've seen some of these numbers make a difference in the in the charts. We saw this actually if you kind of go back to the range we're in from like September until like March. on the S&P, like basically 26,000 for the where is it? I'm looking at the wrong chart for the Nasdaq. 26,000. Well, 26,000 is a round number, and people thought that was significant. Otherwise, it wasn't significant. But those round numbers are also things people look at. So once it breaks out, you want to see, does it break out with like with a mouse fart? Is it like barely breaking out, or is it breaking out with vigor? Well, this is a vigorous breakout, right? And this is what you want to see. You also want to see, is it breaking out on volume? And in this case, we broke out on high enough volume. Yeah, it wasn't tremendous, but it was better than average. So all right, so that's significant. So what's going to happen here? Well, really there's two things that can happen. Well, three things that can happen here. One is it keeps going, which actually in the last few years we've seen a lot of. It's not a high probability bet, but when you see breakouts, sometimes you just keep going. And then people are really left to chase it. Well, that's hard. It's hard if you have to chase it, because people are waiting for that retest of the of the support line now. And when it doesn't, people have to just jump in and hold their nose and buy. It's really difficult psychologically for investors and traders. What's a higher probability bet is you wait for it to retest this line. So as we see here, it's kind of sagged a little bit. And, the high probability in trade would be to wait till it retests the line and then invest. And then it should bounce off that line and then go higher. That is a higher probability bet. So it can either keep going, it could retest the line, which is what I would look for traditionally, or it could break back down lower, which case it's a false breakout, and that's really bearish. So what we've seen in the past is we've seen breakouts, and actually this is a good example here for the S&P. If you look at March, we're in this range. We're in this trading range for many months, for pretty much September until March, and it broke down below the line. And then it broke back. Well, that's a false breakout, right? That's what we call bear trap. And all the people that are going bearish trapped them, and then it started going higher, and then it broke out higher. Well, that's, like I said, if you break out and then it goes back, then it's, in this case, it was bearish. But when we broke out right now, it's bullish. So whichever way it breaks out and then goes the other way is correct, and that's what you want to be careful of. So you want to be careful of bull traps and bear traps. Right now, it seems it's the summer, so I'd be a little cautious. And also because of Trump, who knows what he's going to say tomorrow, but I'd be a little cautious. So this is what the S&P is doing. I would be bullish on this. I would maybe wait to see for confirmation, to see if it keeps going higher or retests, or if it breaks down below. But if you're waiting for a breakout to add, I would add. I wouldn't go all in, but I would start to add for sure, because I do think this is bullish. If you look at the Nasdaq, we're still in the range. Once we had that huge breakout here, we're in the range. We've been in the range pretty much for the last since May as well. So we broke down, right? So here's an example of the bear trap. So we broke down below, and then of course Citadel came out and cleaned out Leopold of his whole portfolio, took all his AI positions, and then we broke back up. Well, that's a bear trap, and then now this is bullish. Now, the thing to think about is the Nasdaq's typically tech focused. So tech is still within the range, it's still neutral. But the S&P broke out. So the indexes are different, but they are related. They do have related positions. The S&P is 40% of 10 tech stocks. So they still have related positions, but the S&P broke out, whereas the Nasdaq is still sideways. Does that mean the Nasdaq's going to keep going higher? I don't know, right? The S&P was going higher late last year, and the Nasdaq was going sideways. So it could be the Nasdaq keeps going sideways and tech is not leading, but everything else is leading through the S&P. So I'd keep an eye on that. Also, the Russell, actually, let me share this. This is another example that I think would be helpful for the conversation, and we'll turn it over to Doug. So here is the Russell, which is small caps, by the way. If you don't know what the Russell is small caps. So here's the Russell. Okay, we were in a range. Actually, it was an upwards trend, but then we hit a range, and then we broke out earlier this week, and then we came back below support. That is what we call a bear trap. I'm sorry, a bull trap. So it broke out, people got all excited, and then broke back down. So that's what we call a bull trap. That's an example of it. And that is bearish. So I like the Russell, but that's actually not bullish. So the question is the Russell in a sideways channel or is it an upwards channel? Because right now, if we're in an upwards channel, that those few down days broke below and we're in that was a bear trap and we're up. So this is the challenge about technical analysis is it depends on how you interpret charts. Are you interpreting the charts as a diagonal channel or a sideways channel? That matters, right? And we don't know. We won't know until it kind of plays itself out. But it is something to watch. It is something to pay attention to. And if you're watching markets and you want to know, what's the index doing and why, if you watch the news, you think, oh, the index is going to the moon and blah, 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 blah. And then you look at a chart, you're like, it hasn't moved in like 6 months. Because much like the casino, when your friends go to the casino and they tell you about the times they won, but not the times they lost, they're like, oh, I won $1,000 on a hand of poker. Like, how much did you win when you were there the whole day? Well, I was down 10,000. Yeah, they won't tell you that. They just tell you about the one hand they won. Same thing with the news. They tell you about the good days. They never tell you about the bad days, or they do tell you about the bad days to scare the crap out of you. But what they're not telling you is how the market's doing overall. They're not looking at it and saying, well, here's how the market's actually doing. They're saying, oh my God, it's going to the moon or going to the floor. They're not giving you the perspective. They're giving you the emotion they want you to feel. And that's why it's important to look at the charts so you can understand what's actually happening. And you can just look visually. You can look at a plain old chart with nothing drawn on it, and you can draw your own conclusions. I'm trying to find one because I draw on most of my charts. But actually, here's one. We'll look at the FTSE, which is the UK index. I don't draw on this chart because I really don't care about it. But looking at this chart right here, this is the FTSE. Okay, all I see are moving averages and then the chart. What do you see here? Well, that looks like it's going up. It looks like there's it's going from the lower right to it's going from the lower left to the upper right. That's what you want, right? That's bullish. Right? Does that mean it's always bullish? No, but we had some bad periods here for the war, but generally it's been going up. Okay, that's important. It's important to know, right? That this is going from lower left to upper right. You can draw on it all you want, but the reality is that this is generally bullish. Now, I would say right now it's at the top range, and there's a lot of resistance here to going higher. But if it breaks out, I would look at that and say, hey, this is a good thing to buy. I'm still not going to touch the FTSE, but regardless, it's just something to see when you're looking at a chart. This is the kind of thing you want to look for. Is it bullish? Yes. Okay, great. Let's put some money to work. So that's what's going on in the markets. This big breakout that we had is important. It's still lazy summer though, and the fact this did not break out on bigger volume, we had it's above average volume, but I wouldn't say it was huge volume. If with a breakout like that, you'd like to see big volume like we see here at the top, near the blue line. You'd like to see volume metrics that high, but it's really, it's above average, but not great. So just something to keep in mind. I'm going to make one more point and we'll hand it over to Doug. And the other point is here's a chart. I want to share this. This is total call option volume. Now, basically a call option is it's basically you're betting that the market's going up. So the more calls, it means that you're bullish on the market. A put means you're bearish on the market, generally speaking. So more calls means we're bullish. So if you look here, pretty much since 22, which is weird because 22 is not a good year, the call options have been going through the roof. Now, some of this is because of the DTEs, which is basically same day options, which I think is just worse than gambling. But a lot of that is due to that. But we had record call options, which means people are overly bullish right now. That's good in a sense. I'd be a little cautious, but that's good. So I see things like this and I say, wow, things are they keep going higher. It's great. It's bullish. Yeah, are we overly bullish, or is it just because there's more volume in calls, more people gambling? I would argue since 22, there's just more people gambling, a lot more retail investors. I would say that institutional investors are not getting more bullish with call options. I don't think that's the case, but I will say that it's interesting that we're seeing a lot more calls on the S&P 500. So, what are you seeing this week, Doug?
Actually, I wanted to turn it back to you one more time, since you're sticking on the topic of the charts. One of the things that came out this week is hedge funds made a massive return to U.S. equities. They injected $4.8 billion on net. It was one of the largest weekly institutional buying surges since 2008. It snapped prior weeks of deleveraging and tech trade unwinding that followed a turbulent July. Bank of America showed that they logged their second largest weekly purchase volume on record relative to market cap. Professional managers, and again, we're getting into August, so they're coming back, right? Spent early to mid-July cutting back on crowded AI and semiconductor longs after high leverage caused severe drawdowns. So instead of staying on the sidelines, the institutional flows pivoted back to buying the dip across the sectors as the oil and bond yield pressures eased. Given that, I was curious to know your thoughts on how to read into that, because that's kind of, that's one of those kind of smart money, dumb money trades. And I just think, since you're already on the topic of the charts and the money, and what's kind of been happening, what's your feedback there?
I mean, if you're looking at like institutional money flows, it depends which indicator you're looking at. But if you're looking at the smart money, if you will, if you're looking at like the COT reports, if you're looking at the futures and COT is typically, you can see the smart money versus dumb money. You can see like the institutional versus the retail. I know a lot of people look at that. I tend not to. It tends to be a little confusing and it tends to be dated. So I think it's good. It's like it's like all the top institutional managers have to report their holdings, like hedge funds, they have to report their holdings. But they're not up to date, right? It's not like, hey, reported and I just did it today. It could have been a while ago, right? They do it quarterly. So it could have been, they could have just redesigned their portfolio just for the quarter. So I tend not to get too hung up on that stuff. I would say 25, 30 years ago, that stuff was very valuable because information was slower, right? If like I didn't go to my computer and see what was happening in the market, I waited for the paper to be printed and saw, what did the stock do yesterday? Like, you get your information from the paper, not from computers, unless of course you were in it. But as a retail investor, you had to wait till it was in the paper. And you charted because you basically took stock prices out of the paper every day and you put it in a chart. Like, it was slower information back then. But now information's readily available. So what do these institutional money managers do? Well, they have a position. Well, they probably bought it like 3 weeks ago or 3 months ago, for all you know. So I think it's challenging to look at a lot of these data sources. I mean, the COT is like a week old, I think. And so, it can be helpful, but not necessarily. I think it's good for longer term trends, but short term stuff, I tend not to. Some people do. Some people live and die by it. I'm not an expert. There's so many indicators in the market. Some people like them, some don't. There's not one indicator everybody loves. So I know people that love the COT. I've tried to learn from them. I don't understand it. It just doesn't sync with me as making sense as a good indicator. Some people use like, moving averages. Some people use, average true range. Everyone's different, and there's a lot of things you can look at. You just have to figure out which ones are right for you. You don't use all of them. You pick some, you get really good at them, you understand them well, and that's what you use. That's what I would recommend doing, and not getting too caught up. But I will say this, that the summer months, so there's certain months out of the year, they tend to be December, like the last week or two of December. They tend to be June, July, August, where institution volume is lower. And what happens in the summer is a lot of the big institutional traders and managers, they go down to the Hamptons. They're all in New York, or at least they used to be all in New York. And they go down to the Hamptons for the summer. And what's happening is, it's not like the fund is not doing anything. They're typically manned by, seconds in command, or like the new guy, or like the interns. Like, they're basically manned by people that are required to go to work and can't spend the time in the summer. But all the big top head honchos are out of there and they're doing other things. So the volume tends to be lower because of this. It's not that it's not that the fund's on vacation, but the volume's lower because they're not doing as much. They may do trades once in a while, but they're not doing a lot of big stuff unless something really drastic happens. Like we go to war. Okay, well, we need to go back to the office and take care of this. But generally speaking, because the summers tend to be a little bit void of information and notable things, they just tend to take a break and spend time with the family and go sailing, whatever they do. And the last 2 weeks of the year tend to be the same thing. So you can get big moves because of this. When you have a lot of volume, the moves tend to be smaller because you tend to have more buyers and sellers. But in the summer months, sometimes you can get some big moves, just like at the end of December. You can get some big moves just because there's only, if you've only got like 3 traders on a desk instead of like 50, and one of them's making a big trade, they move the markets because no one else is on the other side because everyone's on vacation. So you can get big moves, and that is a big cautionary point for the big move in the S&P. I tend not to worry too much about the indexes because the indexes are so big that you tend not to see this discrepancy. But for like an individual position, like a Philip Morris, let's example, that may be too big too. But if you see a single stock, actually, I'll give you an example. So back in like 2012, I think it was, we were trading options on, it was like this last 2 weeks of the year in December, and I was trading options on ExxonMobil, and I saw a discrepancy, and I was like, this doesn't make sense. Let me sell a put on that, and I did. I made quick money because it was a discrepancy because there weren't enough people trading it. I was like, there's no reason it should have been this rich of a premium I could have taken advantage of, and I did. And like 2 days later, it went back to normal, and I took my profits and left. It was only because no one else is trading that during these low volume periods that you can see these discrepancies. So I like these periods because if you're watchful, you can see really cool stuff. But generally speaking, most people on vacation, it's not worth the juice isn't worth the squeeze, as they say. So to answer your question, Doug, I think it's interesting that there's more volume, more people getting in, but I wouldn't take that as my only indicator.
Great. I want to ask you 2 more things. Today's my
Sure.
interview of you, Kirk, because picking your brain, because the chart side. This is for people to know. I don't get into that as much. That's what Kirk's strength. You have a chart on there that I saw talking about. It was showing kind of where the gold boom may be. Bollinger Bands are now the tightest since August 2025, right before gold soared 60% for the next 5 months. We also have some new data that talked about Chinese gold ETFs have now seen 14 straight days of inflows. That's the longest streak since March. On the other hand, we've seen some things that have posted that Bitcoin may be on a breakout. However, a chart did come in the last week or two showing that it just hit the death cross, which again is not, we've seen a lot of things hit the death cross over the last couple of years that have been meaningless. I don't think it has the indicator it used to. But let's talk about those alternatives right now. I mean, silver, I'm starting to see more people are talking about potentially adding up on that again since it's pulled back. Where do you kind of see right now when you look at these things, when you look at both the technicals and the pressure, the buying pressure on it, where are you kind of seeing crypto or specifically Bitcoin, gold, silver?
Yeah. Thanks for the question, Doug. So I'm sharing right now the gold futures for like the last few decades, and I'm doing this just to give you perspective. So if you look at gold, this is typically what gold does: is it will go sideways and then it'll shoot up. It'll be a secular bull market for like a number of years, from like basically 99 until like 2011 or 12. I forget which one it was, but gold went into a bull market, and then it went sideways, went down for a bunch of years, and I call it sideways because it didn't really go down. It was just, took some steam off and then went sideways. It went sideways for about 15 years. And then and then in the 20s, it broke out. I think it was 23. I think it was. I forget which exact year. But then it broke out and it rocket shipped up for the next few years. And now it's like, it's taken some steam off. I don't know if that's going to be temporary or bigger, but right now we're in a secular bull market in gold. So just the fact that we're taking some steam off right now, in my opinion, it's going to take another probably 1 to 2 years before gold starts to take off again. I'm not necessarily saying that's going to happen, but if I had to guess, that would be a normal expectation. But here's gold, okay? Here's what we saw. I know there's a lot of lines in here, just try to ignore them. But, we saw a huge run up in gold, ended at the end of January, went down, then it came back up, and then it went down again, and it came back up. But basically, we're having a downward slope. Now, if you take this line and draw it out, and I haven't done it here, we broke through that line this week, and that's bullish. Now, I'm a little cautious because gold will typically do these fake outs. There's way too much energy here in the last year. Gold went up way too much in the last year. Now, I'm not saying it's bad. If you own gold like we did, love the fact it went up. But I would rather see gold going up 20% a year than going up 100% a year. Because if you're going up 20% a year, gold can do that for a long time. If you're going up 100% a year, that means you've got 4 years that you need to even that out of 20%. So I'm not saying it's going to go down or sideways for 4 years, but that's a lot of energy that has to burn off. I think of the markets in terms of energy. When there's too much energy, at some point it needs to either go sideways or down. Sideways is bullish, down is not. So I look at this as sideways, right? Because we broke out, went up, went down. We're in this kind of sideways period. And when it breaks above this, I would say, all right, we're back to bullish. But I would be very, very surprised if that happens short term. Now, Doug brought up the Chinese buying. There was some news out this week about Chinese buying gold. Great. Yeah, they bought a lot of gold. You know what? They've been buying a lot of gold for a long time. Okay. It's nothing new. If you look at so the thing you have to understand about gold, there's a lot of listeners who like gold. Okay. And I'm with you. I like gold. However, what you need to understand about gold is everything you read about gold is BS. It's complete bunk. And here's why. When you look at gold, people bring a lot of factors that influence the price. Oh, well, the dollar. If the dollar goes down, gold goes up. Not on a day-to-day basis. That's not how it works. Because you'll see that in the news, but not every day, because the other days it doesn't do that. I tend to see that it's not a good influence. The dollar tends not to be a good influence on gold because the dollar is compared to other currencies. So I don't think it's a good indicator of whether gold is going up or down. Okay, so throw that out. Another indicator people bring up is central banks buying. That's increasing the price of gold. Yeah, central bank buying of gold is a constant. It's constantly buying gold. A lot of them are. So it's just like it's like a relentless bid in the gold price. Well, they're mining gold all the time, so you need to have people buying it. So if you're mining 100 tons of gold and you've got demand of 100 tons of gold from retail and central banks, then the price isn't going to go anywhere because supply and demand are equal, right? But if central banks came in and bought like twice as much, that would bring up the price of gold. The problem is they've been pretty consistently buying it. They don't go in and buy like an overwhelming amount. The problem with China is China does not report accurately. They will typically not report at all, and then 3 years later they'll report a chunk. So it's hard to gauge China. People, when they report, people are like, oh my God, they're buying a ton. Yeah, but they just didn't report for the last 3 years. So I tend to not look at China as an indicator. Yes, they're buying gold. Yes, Russia's buying gold consistently. And many other central banks are buying gold consistently. I will argue that in March and subsequently, many central banks are actually liquidating their gold holdings because they need cash. Turkey is a notable one that has said, hey, we need cash, so we're liquidating our gold holdings, which is why it's there, right? So you could argue that suppressed the price of gold. I don't know if it is. You'd have to look at supply and demand measures on that. But you could argue that, all right, if central banks are selling gold, that's probably going to suppress the price a little bit because that's not normal. But in general, I would say there are certain companies, JP Morgan being one of them, that tend to manage the price of precious metals. They have a precious metals book, silver being the more notable one. So is that why the prices are going up? I don't know. People claim they know. I don't know why the prices are going up. I remember in 2010, it was tax day. It was April 15th. Gold was kind of, if you look at this chart here, right around, I was looking at the wrong one, right around 4,000 is support, okay, on gold. And if you look at like 2010, the equivalent would be, it's bounced around there and then it broke down to like 3,500, like just sharply breaks below this. And on tax day in like 2011, I think it was, everybody claimed there was a fat finger trade and that China sold all their gold holdings and that's what broke down and blah, 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 blah. I heard all the excuses. You know who knows the answer? No one. Zero people know the answer to that question of what happened, because there's too many factors at play. There's no way that CNBC knew there was a fat finger. Did that person admit there was a fat finger? No, nobody's going to admit that if they made that kind of error. Absolutely not. And furthermore, and no one is going to know that happened. So in order to know, you would have to be in the bowels of the financial system. You'd have to be the plumber of the financial system. Yeah, there might be a handful of people that know, but they're certainly not going to say anything. And so you have to understand that generally speaking, no one's going to know the reason. And you have to be comfortable with the fact that you're not going to know the reason. Now, the reason that charting is helpful is because you don't have to know the reason that things went up. Well, yeah, Trump said, the war is over. We're going to put a pause or whatever the reason is. It doesn't matter. But the market reacted and it went up. Okay, well, I'm sure this weekend he's going to start the war again and it's going to go down and blah, 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 blah. We're going to be on this train over and over again. I don't get too excited about this stuff. If you start to see a trend higher like we saw in the last few years, I'm excited about that. Am I excited about a breakout in one day? No, I mean, look at this. It broke down and then it broke back up. I don't get excited about that stuff, right? If it keeps going, awesome, but that's not the start of a trend, right? It's the start of a move. And if we start to see it break out above the 200-day and keep going higher, okay, then we're starting a trend. But I would just be a little cautious. I wouldn't get overeager. I wouldn't get overly fearful. I would just say, let's just watch and see if there's confirmation. So in general, you can mark certain events for stocks, right? Good earnings, and you see a breakout. Okay, it's because of the good earnings. You can clearly mark the point in time that the earnings report came out and the CEO or CFO said A, B, C, or D, and then the stock breaks out or breaks down. You can mark that. That is clearly obvious, the reason why that thing moved. If the central bank came out and said, we usually buy 100 tons, we're buying 1,000,000 tons, yeah, that's going to move it. But they don't do that because they don't want to skew the markets in that way. So it's probably never going to happen. So in general, you can't note a news report and say, this is why. Just ignore it. I know it's hard. You're a human being and you want to find a reason. There's no reason. Just get over it. So I would just say, just watch the charts, watch for confirmation. You asked about gold. This is the gold chart. If you look at silver, this is a silver chart. I'm less bullish about silver. I think silver is, as far as I know, silver still has a huge short position by JP Morgan. They're the ones that run the short book they have been for decades. So it's not new. It's not news. They went long and all of a sudden this went up and then they added the short back and then it's suppressed again. So I think we're in for some suppression period. Now you mentioned Bitcoin. This chart is actually more interesting. People like Bitcoin, love it, and they die. They'll die for Bitcoin. But this is what's going on in Bitcoin.
It is a religion.
It is a religion, totally. And so basically what's happened is you've seen these periods where it goes sideways and then drops. And then it starts to go up and then drops. These are flag movements, okay? This is what the technicians would call flags. So, or bear flag. So it's gone down, goes into a flag movement, slightly up, and then breaks down. And we're seeing it go up again. It'll probably break down again. My estimate is we're going to see 37,500 is my target for Bitcoin by the end of the year. I don't know if it's going to happen, but I will get excited at 37,500 or that range. I will get excited around that price. And I do think there'll be tax loss selling at the end of the year for Bitcoin, which would be fantastic time, because everyone's going to be selling their Bitcoin at the end of the year for tax losses, and then they'll buy it back, in the new year. So I would get really excited about Bitcoin getting into like December 31st timeframe. But we'll see, assuming it's still going down. But I'm not bullish on Bitcoin. The investors, the speculators are not looking at Bitcoin as the movement of money. If you think of the market as like movement or energy, I think of it as like a flow. Like you're in the sea, you're in a tank, right? You're in a pool, and there's water, and it has to flow somewhere, right? You push down one end of the pool, the water on the other end is going to go up, right? The water has to go somewhere; it can't just disappear. So the market's much the same way. The money flow, it's like water, right? And so last year it was flowing into Bitcoin, and it drove the price up, and then the flow went into gold and silver, and then drove that up. And when that happened, the price of Bitcoin went down, because all the speculators left Bitcoin, and then they went into gold and silver. And then gold and silver crashed at the end of January, and then all the speculators left that, and then they went back into something else. They went to energy stocks, and then they went into tech stocks and semiconductor, and now they're into value. And they keep rotating from one place to another, because that money has to go somewhere, the speculative money. And if you can see here, it's clearly not going into Bitcoin. Okay. So at some point it will. I doubt it will before the end of the year. I'd be very surprised if that happens. Now, if Trump comes out and says, hey, we passed this bill and blah, 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 blah on crypto, okay, maybe it goes up. But withstanding that, which I don't think is going to happen before the election, withstanding that, I think we're just looking at lower crypto prices. That's my speculation. I don't know if it's going to happen, but that's what I would speculate. So, yeah, I don't know. I'll hand it back to you, Doug. I got more to say, but I'll hand it back to you.
Yeah, so I've got tons to say on that too. And by the way,
on time, actually.
Yeah, I know we are running out of time. So I'll save some stuff. I got some great charts on that for next week.
Yeah.
And I'll just run into this really quickly and say two things. A, you just made a lot of Bitcoin holders cry by calling for 37. I will say I have a chart that's on the opposite that's hilarious that says it's going to 300,000. So once again, the news. I also, Jamie Dimon, you mentioned Bank of America and their shorts and flip and flopping. They posted that they seized the S&P 500 set to rally as a buy signal flashes right after Jamie Dimon says the markets underestimate the risks and wouldn't buy stocks or treasuries at current prices. So again, watch the news. It goes back and forth. Another thing I thought was interesting is we always talk, there's that old saying, sell in May and go away. July just posted, even though it pulled back, it had the rally at the end. Green July for the 12th consecutive year, which was a heck of a comeback to end out the month. You talked about gold, number one export for the United States over anything, not semiconductors, not pharmaceuticals. Gold is our number one export. According to the U.S. Census Bureau, January to May 2026, $64 billion of gold was exported. Second was crude oil, then pharmaceuticals, then petroleum products, which interesting because that's tied to crude, semiconductors, civilian aircraft engines, and computers. So congratulations. We are a third world country exporting raw materials. Another thing that I saw there that is, again, why it's so confusing and hard to see. You've got charts showing that the bull market's ready to die, that it's the most overvalued market in 100 years, following the same blueprint. Bank of America just reported in their bull bear indicator it's the strongest sell signal in this century. Yet on the other side of it, U.S. equities, actually with their valuation reset, are now the cheapest valuation relative to the rest of the world in 6 years. So again, lots of conflicting data. And the last thing I'll say before I close it out, the AI boom is becoming the largest investment surge in history. So we talked about the .com boom, that it had existed. There was the Roaring '20s, the railway mania in Britain in 1843, and the canal mania in the U.S. in 1853. Interestingly enough, as big as the .com boom was, it was a relatively flat pre-boom trough scale over its economic growth. The largest, boom to bear was the canal mania of 1853. But AI is surpassing all of that right now in terms of economic booms. Again, all of the rest of them, we have the history to see what happened. Most of them actually relatively flat. The railway mania spiked and then stabilized. Dot-com boom actually relatively spiked and stabilized, as did the roaring 20s until we got in the Great Depression. At the end, they dipped negative under 100. The canal mania, the canal mania of the United States was absolutely the worst decline. It on this pre-boom trough equals 100 log scale. I'm just getting technical. It moved from 100 close to 400 before it dipped down under 20. So that's how bad it blew up. Right now, the AI boom, and this was as of 2023 from the Bank of International Settlements, shows that we are ahead of the canal mania. We're close to 500 on that scale. So again, looking at everything, it's the highest growth on that scale in economic boom we've ever seen. Again, the future will tell. The last thing I did want to address before I close out, Kirk, you did speak about year-end selling on Bitcoin. The one thing I want to remind people is if you're owning ETFs, then you'll definitely have a chance of seeing the Bitcoin selling at the year end. If you are actually holding Bitcoin, a reminder that it does not follow the same rules. If you're trying to take your losses, you could sell that now and buy it back tomorrow. It's not subject to the wash rules under the current under the current laws. So that definitely
unless you're buying ETFs.
Correct. And that's why I said
ETFs, yeah.
That's what I clarified. If you're buying ETFs, that's the year end. If you actually hold Bitcoin, you're not subject to those same rules. All right. So to close out, because we're already past the time, I just wanted to mention, I keep coming back to something that happened this week. The other day, I had the opportunity to present to more than 200 CPAs. These are smart people. These are people that spend their careers working with tax law, financial statements, and solving complex financial problems every single day. And when it was over, the overwhelming feedback wasn't, give me more information. It was, help me make sense of all of this. And I thought, isn't that where so many of us are today? We've never had more information. We've never had more opinions. We've never had more headlines. We've got jobs, inflation, AI, the Fed, tariffs, oil markets. Every day there seems to be another reason to feel like you should be doing something. But information isn't the scarce resource anymore. Clarity is. And that's why at our firm, Mergent Advisors, we focus on a few areas where getting it right can completely change a family's future. Helping families pay for college without sacrificing retirement, which college planning and college funding was my topic for the CPAs. In fact, if college is on your horizon, our College Money Report is a great place to start. It's free, and you can put in 3 schools and see what they would really cost and look at a reality. And by the way, college planning is something that people start last minute in their senior year. The reality is that FAFSA is looking at financial information that could start as early as January of your child's sophomore year. So by the time you get to your senior year, you're already a little bit too late for a lot of planning opportunities. And what I was talking to the CPAs about this week wasn't necessarily how to plan if you need money for college. It was actually how you can create some great tax incentives and a lot of ways to pay for college to reduce your taxable impact for high income families. So helping people transition from accumulating wealth to creating retirement income comes into that too, because the more you save, the more you'll have, and that they can actually live on with confidence. So with wealth mapping, making sure taxes, investments, retirement, college, insurance, and estate planning all working together, not siloed, instead of operating separately, because this is one of the biggest risks we see. It isn't bad advice. It's good advice. I hear it all the time. I look at the advice people get. It's like, yeah, that's great advice, but it was never connected. And that causes the domino effect to make all of that good advice fall away. So if you've ever found yourself wondering, am I paying for college the right way? Can I really retire when I want? Or if you're in a high income but high stress job, I make a great income. I got to keep working. Why would I give that up? when the reality is that every day that stress is degrading you a little bit. And the question is, could you get to a point where you can actually have the choice of saying it's okay to walk away from that stress? Can I retire or work optional when I want? Will our plan still work in life if it doesn't go according to plan? Those are exactly the conversations that we have every day. So please go visit mergentadvisors.net. Spelling is MERGENT, MERGENT, mergentadvisors.net. The goal isn't simply to know more. There's tons of information out there, and it gets more every day thanks to AI and just the access to the internet. The problem is understanding what matters and having the confidence to then act on it. And so I'll leave you with this. The greatest luxury money can buy isn't a bigger portfolio. It's a quieter mind. Thanks, Kirk. I look forward to seeing you again next week.
Yeah, thanks for joining us, Doug. And that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week around the show. Did you miss something on the episode? You're looking for the show notes and resources? Check out our show at moneytreepodcast.com. Oh, don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you products or services, so do not consider this advice. If you're seeking financial advice, give us a call. We take clients selectively, but only if we like you. So if it happens we don't like you, there are plenty of advisors out there who work with anyone with a heartbeat and two nickels to rub together. Like I said, we're selective. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.